Imagine for a second that you're at an auction and there's this priceless, like one-of-a-kind antique sitting right there on the block. And it's going for just a fraction of its actual value.
Which is, the dream scenario.
Right,
Yeah.
exactly. And you actually have the money to buy it. Like, it's sitting very comfortably right in your checking account. So you raise your paddle, you win the bid, and you walk up to the auctioneer to, claim your prize.
But then the catch happens.
Yeah, the catch. You reach into your pocket to pull out your wallet, and this giant padlock just snaps shut over it, and a little digital timer appears on the lock that says, funds available in 45 days.
Oh, man. I mean, by the time that timer hits 0, the auctioneer has already sold that antique to the person standing right behind you who actually had cash in hand.
Yeah.
You lose the deal.
Yeah.
And not because you couldn't afford it, but just because your money wasn't fast enough.
And that agonizing delay, that's the hidden reality of the real estate market. But today, we're doing a deep dive into a stack of sources from a San Diego lending specialist. These were authored by John Constantine in mid-2026. And, it just reveals this entire parallel financial universe.
It really does. It's a world where buyers are just completely bypassing the retail bank to close these massive real estate deals in days, not months.
Right. Okay, let's unpack this because we are going to decode the hidden financial architecture that powers high-stakes real estate investing.
Which is something you really need to understand because it completely reframed how you look at property altogether.
Yeah, totally. So whether you are looking to buy your first investment property or, maybe you're a self-employed entrepreneur or you are just insanely curious about how these distressed properties get snatched up and flipped seemingly overnight, this deep dive is going to break down exactly how it works.
Because, most people view real estate strictly through this lens of a standard 30-year mortgage.
Right, the classic bank route.
Exactly. You think about going to a big retail bank, handing over like a decade of tax returns, and just waiting weeks and weeks for an underwriter in some other state to rubber stamp the approval.
Which takes forever.
It does. But these documents, they pull back the curtain on something called asset-based lending. And in this alternative market, speed is just the ultimate currency. Understanding it, well, it completely shifts how you view the housing market.
And I think the best place to start is the San Diego coastal market, right? Because the sources use that specific area to illustrate the fundamental flaw of traditional banking.
Yeah, the San Diego market perfectly demonstrates that crazy friction between incredibly high demand and just very limited supply.
Right.
So when a distressed property hits the market, say, I don't know, a house in Pacific Beach with a literally caved-in roof that needs a massive overhaul, it doesn't just sit there for months waiting for a buyer.
No, of course not. It probably moves in, hours?
Hours, yeah.
Yeah.
Multiple cash offers materialize almost instantly.
So bringing a 45-day traditional mortgage pre-approval to a hot San Diego real estate deal is it's basically like trying to win a drag race in a minivan.
That is a perfect analogy.
Right. Sure, the minivan will technically get you to the finish line eventually, but the cash buyers and those investors with agile financial partners, they are going to blow past you every single time.
Oh, absolutely. And the alternative engine for that drag race, so to speak, is the hard money or fix and flip loan.
Okay, so how does that actually work? Because it sounds kind of intense.
Well, these are asset-based loans. So the lender focuses primarily on the intrinsic value of the real estate itself, specifically something called the after-repair value, or ARV.
That's your repair value. Okay.
Right. They evaluate what the property will be worth once all the renovations are complete, rather than just obsessing over the borrower's personal credit score or, W-2 debt-to-income ratios like a conventional bank does.
Wow, that shifts the entire power dynamic. You aren't going in and begging a bank to trust your personal financial history. You're asking a financial partner to leverage the future value of a specific asset.
Exactly. And what's fascinating here is the psychology of the seller in these distressed scenarios.
Oh, right, because a seller with a caved-in roof usually isn't, holding out for the absolute highest possible retail price.
No, not at all. Sellers of distressed real estate prioritize the certainty of closing above almost everything else.
Because they just want out.
Exactly. They might be facing foreclosure, navigating a really messy divorce, or maybe dealing with an inherited property they just can't afford to maintain. They want out, and they want out today.
Yeah, they cannot risk waiting 45 days just to find out a retail bank denied the buyer's loan at the last minute because of some, minor paperwork snag.
Right. So presenting an offer that's backed by an asset-based lender with a promise to close in, 7 to 10 days, that makes you look practically identical to a cash buyer.
because you are signaling to the seller that the transaction is going to completely bypass the bureaucratic nightmare of a retail bank.
Exactly. But once you secure the property with that kind of speed, well, the immediate challenge becomes funding the actual transformation. Buying the distressed house is literally only step one.
Right, because now you have an ugly house that needs a lot of work. So how do they fund the renovation without running out of cash? Because renovations are notoriously expensive.
Well, the actual machinery of the fix and flip loan is structurally designed to cover a significant chunk of the initial purchase price, plus up to 100% of the predetermined renovation budget.
Wait, hold on. Let's look at the math on that for a second. Because covering 100% of the construction costs sounds like an unbelievable risk for the lender.
It does sound crazy at first glance.
Yeah, like they obviously aren't just handing a contractor a briefcase full of cash on day one and saying, hey, hope a new kitchen gets built.
No, definitely not. The system mitigates that risk through something called structured draws.
Structured draws. Okay, how do those work?
Basically, the funds allocated for the renovation are held safely in escrow. They are only released in tranches or draws as very specific phases of the construction are completed.
Oh, I see.
Yeah, so the contractor finishes the rough plumbing and the framing, an inspection happens, and then a portion of the money is released to pay for that exact specific work.
Okay, wait. I see a huge flaw here, though.
Oh, what's that?
Well, if my lender is sitting in some corporate office in Manhattan, right?
Oh.
And my drywall guy finishes a massive job in San Diego on a Friday afternoon, is that New York lender really going to wire him money that exact same day? Because if they take a week to process the paperwork, that drywall guy is packing up his tools and walking off the job.
And you've just identified the exact fragility that absolutely destroys amateur flippers.
Really? So that actually happens?
All the time. The source material heavily stresses the necessity of working with a local lender to solve that exact bottleneck.
Right, because if funding draws are delayed, the construction crews just leave.
Exactly. That stalls the project. And in this business, an extended timeline fundamentally destroys your profit margins through holding costs.
Oh, right, because you are paying monthly interest on that loan regardless of whether the hammers are swinging or not.
Precisely.
Like if you have $1 million loan at, say, a 10% interest rate, you are bleeding over $8,000 every single month just in interest. And that's not even mentioning like property taxes and insurance.
Which adds up incredibly fast. But a local San Diego lender utilizes local inspectors. So when your drywall guy finishes on a Friday, an inspector can physically drive out to the site that same afternoon, verify the completed work in person, and authorize the release of the next capital tranche immediately.
Wow. Okay. So the physical proximity of the lender directly dictates the speed of the actual construction.
It really does. But the sources also highlight another massive danger where local knowledge is just absolutely non-negotiable. And that is the concept of micro-markets.
Right. Micro-markets. This stood out to me.
It's a classic trap for out-of-state investors who, they just look at spreadsheets and don't know the actual streets.
Yeah. The texts detail this scenario where an investor executes this really high-end luxury renovation, right? And that level of finish yields incredible returns in a wealthy coastal enclave like, say, La Jolla.
Beautiful area, very high price points.
Exactly. But if you take that exact same design and execute that renovation in a working-class neighborhood like El Cajon, you have completely over-improved the property.
You've doomed the project from the start.
Yeah, you spent, what, $150,000 on imported marble and premium fixtures, but the buyers in that specific zip code literally cannot secure a mortgage large enough to cover those upgrades.
Right, because the surrounding houses don't appraise for that much.
Exactly. You've priced the home entirely out of its own neighborhood, which just results in a total loss of capital.
And that's exactly why a local lending partner with hyper-local market intelligence is so crucial. They help validate your ARV estimates before you ever even purchase the house, which prevents you from overbuilding in the first place.
Okay, so mastering those mechanics, acquiring fast, funding through local escrow draws, and understanding micro-markets, that is basically how an investor survives their first project.
Survives is the key word there.
Right. But the texts outline this very explicit tier system showing how wholesalers and beginners actually scale their operations to manage multiple concurrent projects.
And this is where the math gets really fun. Capital costs decrease as your experience and your deal volume increase.
Here's where it gets really interesting, because when I was looking at the chart breaking down these investor tiers, it felt exactly like leveling up in a video game. or like a frequent flyer program.
Yeah, that's a great way to put it.
You start at the bronze tier, which is for investors with 0 to 2 completed flips. At bronze, the lender offers up to 70% loan-to-value, or LTV. You pay around 2.5 to 3.0 origination points, and the funding speed is targeted at 7 to 10 days.
Okay, let's translate those terms into actual dollars so you can really picture.
Yeah, let's do the math.
If you are buying a property where the total project cost is $1 million, a 70% LTV means the lender provides $700,000.
Okay.
You, the investor, still have to bring $300,000 of your own cash to the table to make it happen.
Right, which is still a lot of money.
It is. And then those points you mentioned, those are upfront fees based on the loan amount. So 3 points on a $700,000 loan is a $21,000 fee paid right at origination.
Okay. But even with those fees and even having to bring $300K to the table, closing in 7 to 10 days still keeps you highly competitive against pure cash buyers.
Absolutely. Get your foot in the door.
But as you prove your track record, you graduate, right? You go to silver for 3 to 5 flips and then gold for 6 to 10 flips.
And at each step, the interest rates drop, the points drop, and the approval speed actually accelerates.
Which is awesome. But then you unlock the boss level, the platinum tier.
Ah, yes. Platinum. This is reserved for seasoned investors with 11 or more completed flips. And the terms here, I mean, they shift the entire financial landscape.
How much of a shift are we talking?
Well, you can secure up to 85% LTV.
Wow.
Yeah. Origination points plummet to just 1.0, 1.5. And most staggeringly, assuming you have a clean title and a clear scope of work, they target approvals guides of just 2 to 4 business days.
Wait, 2 to 4 days to fund a 6-figure real estate transaction? That's insane.
It is. But the real aha moment is what that 85% LTV actually allows you to do as an investor.
Oh, right. Because going back to our $1 million project example, instead of bringing $300,000 to the table, the lender is now covering 85%. So you only need to bring, what, $150,000?
Exactly. And that is the power of extreme leverage.
Right. Because
If you have a fixed pool of $300,000 in personal capital, the bronze tier allows you to execute $1 million flip at a time.
Okay, I see where this is going.
But the platinum tier allows you to take that exact same $300,000 and split it across 2 concurrent $1 million projects.
Oh, wow.
Yeah, effectively doubling your potential profit in the exact same time frame.
So this tier system isn't just a generous rewards program, it's calculated risk mitigation for the lender.
Exactly. A borrower who has successfully navigated 12 flips is a known quantity. The lender knows this person knows how to manage contractors, they can navigate permit delays, and they price a finished home accurately.
Right, they're not going to make those rookie micro-market mistakes.
Exactly. A proven track record drastically lowers the lender's risk profile, which then allows them to offer cheaper, faster money.
And this cycle of mutual growth empowers those experienced investors and even investment syndicates to target much larger, more complex assets, right?
Yeah, the documents specifically mention these groups migrating from single-family flips into multifamily apartment complexes in emerging San Diego neighborhoods like North Park or Logan Heights.
So they just scale up the exact same model. But, mastering this fast cash system isn't just for people trying to flip a house by next month.
No, definitely not.
The real secret revealed in these texts is how investors use these exact same short-term tools to build permanent, long-term rental empires.
Yes, the BRRRR method.
Right. They utilize a strategy known as BRRRR, which stands for buy, rehab, rent, refinance, repeat.
It essentially requires a 2-step financing dance.
Okay, lead us through the dance.
So the investor leverages a short-term hard money loan to rapidly acquire and renovate the distressed property, just like we discussed.
Right. Get in fast, fix it up.
But once the building is fully remodeled and generating rental income from new tenants, they do not sell it.
They hold it.
Exactly. They refinance out of the expensive short-term hard money loan and into a long-term product designed specifically for rental portfolios. The DSCR loan.
DSCR. That stands for debt service coverage ratio, right?
You got it.
And this is a massive workaround for anyone who doesn't fit the traditional banking mold, because a traditional bank heavily weighs your personal W-2 income to see if you can afford the mortgage, right?
Right. They want to see steady paychecks.
But the DSCR loan looks almost exclusively at the property's income.
Exactly. If the monthly rent generated by the tenants is, say, $4,000, and the new mortgage payment is $3,500, the property generates more cash than it costs to hold.
So the ratio is positive.
Right. And because of that, the lender approves the loan based on the asset's performance. entirely bypassing the investor's personal tax returns or W-2 history.
It's an incredibly powerful wealth-building tool. But, I mean, the sources issue some pretty stark warnings about executing this, especially on larger multifamily properties. If you mess up the sequence, you can basically bankrupt the project.
Oh, easily. The texts highlight 3 catastrophic mistakes that multifamily investors tend to make.
Okay, what's the first one?
First, failing to calculate the complete renovation budget before securing the initial loan. If you run out of funds midway, the whole project just stalls.
Right, and you're still bloating holding costs.
Exactly. Second, using overly optimistic rental projections instead of highly accurate current market rents when applying for that DSCR refinance.
Oh, I see. Because if the actual rent comes in lower than what you projected, you just straight up won't qualify for the long-term loan.
And then you're stuck in the expensive short-term loan, which leads to the third mistake, which is ignoring the timeline.
Right, the timeline. The sources insist on building a 3-month buffer into every construction schedule.
Because if you hit, say, hidden plumbing issues and your renovation extends past the maturity date of your short-term loan, the penalties are absolutely brutal.
Like what kind of penalties?
You get hit with massive extension fees or these strict prepayment penalties that can wipe out a year's worth of projected rental profit in just a matter of days.
Wow. Okay, so precision is key. But everything we've discussed so far seems geared toward heavy-hitting investors or big syndicates.
It does sound a bit intimidating.
Right. So what does this all mean for the listener who isn't a massive real estate syndicate? Like, can a first-time investor actually use these?
If we connect this to the bigger picture, yes, absolutely. First-timers definitely can use these tools, though they might need, much more detailed renovation plans and contractor estimates to get approved.
Which makes sense. But there are also tools in here for people who aren't even investors at all, right? Like self-employed professionals. I know plenty of small business owners who make excellent money, but because they maximize their legal tax deductions and business write-offs, their taxable income looks artificially low on paper.
And a standard retail bank will look at those aggressively reduced tax returns and just outright deny the mortgage application.
Which is incredibly frustrating for them.
It really is.
Yeah.
But the alternative lending market offers something called a bank statement loan to solve this exact discrepancy.
Right. So instead of using tax returns to prove your income, the lender evaluates like 12 to 24 months of your actual banking record.
Exactly. They look at the real cash flowing in and out of your business every single month.
Which is way more accurate.
It is. It allows entrepreneurs to secure a property based on their actual financial health without forcing them to abandon their completely legal tax strategies.
That's huge. And there's also a specific tool designed to alleviate one of the most stressful experiences a traditional homeowner can face, which is the bridge loan.
Oh, bridge loans are game changers.
Right, because imagine you own a house and you find your absolute dream home across town. The problem is, all of your wealth is tied up in the equity of your current house.
Most people's wealth is.
Yeah, you don't just have a spare $100,000 sitting in checking for a down payment. So in a traditional scenario, you are forced to make a contingent offer on the dream home.
Basically telling the seller, I want to buy this, but only if my current house sells first.
Exactly. And in a competitive market like San Diego, sellers throw contingent offers directly in the trash.
Without a second thought.
So the only other traditional option is the dreaded double move. You sell your current house, move all your belongings into a temporary rental, wait for the bank funds to clear, and then try to purchase the new house.
Which is wildly expensive and just incredibly stressful for a family.
But a short-term bridge loan fixes that, right?
It does. It allows you to borrow against the equity in your existing home before it actually sells.
So it hands you the immediate capital required to make a strong, non-contingent down payment on the new property.
Exactly. You secure the dream home, you move your family and your furniture exactly once, and then you calmly list your old house on the market without this ticking clock hanging over your head.
It's just all about accessing flexible capital that matches the reality of your life, rather than contorting your life to fit the rigid algorithms of a retail bank.
That is the overarching lesson from these sources. Success in real estate isn't just about finding a property with good bones in a nice neighborhood.
No.
It is entirely about matching the speed of your capital to the speed of the market.
Yeah. We've gone from the agonizing frustration of a 45-day traditional bank delay to this crazy parallel universe where platinum-tier investors use localized efficiency to fund 6-figure acquisitions in just 2 days.
It's a completely different paradigm.
It really is. And by understanding these mechanisms, How ARV dictates asset value, or why structure draws demand local inspectors, or even how extreme LTV leverage multiplies your wealth, you transition from a passive observer of the housing market into someone who grasps the underlying financial engine.
You truly do.
You aren't just looking at houses anymore, you're seeing the machinery that moves them.
And honestly, it leaves you with a rather profound question to consider as we wrap this up.
Oh, what's that?
Well, we've seen how asset-based lending uses hyperlocal intelligence and really clear data to safely fund these massive transactions in under a week.
Right.
If a private lending institution can securely manage that level of risk in 2 to 4 days, is the traditional 45-day banking model eventually doomed?
Oh, wow.
I mean, think about it. As technology and data analysis continue to accelerate, perhaps this hyper-efficient world of hard money isn't just a specialized niche for flippers anymore.
Right.
Perhaps it's actually a preview of the future of all home buying.